Ethics, a focus on the 7 threats, was a live webinar that was originally produced on Thursday, September 26, 2019. For this webinar, we were joined by Michael Hoffner and Janice Snyder, partners at McKonly Asbury. We hope you enjoy this recap, and please visit us online at MACPAS.com for more information about our future webinars and other events.
Thanks, Melissa. Appreciate being here today to talk about our annual discussion on ethics and exploring some of the professional guidance that surrounds what we do. So look forward to the next hour and hopefully digging into and enlightening you a little bit on some of the key areas that we decided today was important for us to talk about. Again, my name is Mike Hoffner. I'm a partner at the firm. I work with Janice overseeing our assurance services at the firm, primarily focused on our SOC, our system and organization controls, manufacturing, construction, benefit plans, and a smattering of other things. I also have the pleasure of being the chair of our firm's independence committee, dealing with the occasional issues that come up in terms of conflicts of interest or some of the things we're actually going to be talking about today.
Great, thanks, Mike. I'm Janice Snyder. I'm a partner here with Mike as well. We work together a lot on assurance services and lead our assurance practice. I've been doing audits for about 20 years now, and I do specialize in working with our healthcare clients, nonprofit organizations, manufacturing clients. A lot of them happen to be food manufacturers, to be a little more specific, as well as some benefit plans. And we're excited to focus on the 7 threats here today. We listened to your feedback last year, and a lot of you were interested in exploring these threats in a little more detail. So that's what we're going to spend the next hour doing.
So a brief overview of where we're going to spend our time. As Janice said, we're going to get into the 7 threats, and we'll talk about what that means in just a minute. But first, I think it's important to start with a high-level overview of the AICPA Code of Conduct. We have in the past done extensive webinars covering the entire code, how it's structured, what its origins were, how to read it, how to interpret it. Those webinars are available via archive. If you have that burning and yearning desire to go understand more about the AICPA Code of Professional Conduct, I invite you to go seek out those webinars through our website and our archives. But we aren't going to get into a tremendous amount of detail on the code other than a high-level overview, because I think it sets the tone for what we're really going to talk about, which is the 7 threats to compliance. And it's really a framework that offers a number of things to think about, whether you're in business or in industry, offers a way to think through what kinds of dilemmas we might face and how to process those. And then ultimately we'll talk about in particular safeguards that can and should be put in place. Again, we know safeguards don't necessarily mean we stay ethical, but they're things that will help us stay on the right track and help us work through some guards to make sure we do the right thing and make the right choices. So that's a little bit of overview of where we're going to be. So as I said, we'll start with just a history, a review of the Code of Professional Conduct. The current version of the code was released in 2014, and if you joined us on the previous webinars, you would remember our conversations about the Code of Professional Conduct and the Code of Ethics prior to that being very difficult to read and interpret because it evolved over time and things that weren't relevant were taken out, new things were added in. It became very prescriptive and rules-based. And so in 2014, the AICPA released the new Code of Professional Conduct, which is much more of a framework focused. The other thing it did, which was very significant at the time, was to address in separate sections of the code some of the things you need to think about if you're in public practice, but then realizing that was very severely lacking in the previous code, there's a new section that was developed for members in business. The old code really talked about public accounting. If you're in an audit and attest function, here's how you have to think through things and interact. But so many licensed professionals spend their careers or a significant portion of the career in industry and in the business side. And the old code really didn't speak to that. So the new code, I think, was a significant step in the right direction, just to help unpack and follow things that are more specific to what you're actually doing in your profession. So the new code is Very much a framework-driven, interpretation-driven, organized in a very structured way. For those who work on the tax side, I think when we move to this new code, it follows a little bit more of maybe an IRS code idea where you work through topics and subtopics and then get into interpretations. Just much easier to follow, much more organized, and allows us to, when we have a question or something to work through, allows us to actually find not necessarily a black and white definitive answer, but allows us to actually find guidance that speaks to what we're dealing with in a way that we really couldn't do under the previous version. The whole focus of today's conversation, as Janice said, some feedback came out of previous webinars about unpacking some of the things in the code that we really flew through in the past. Those things today will be focused on this threats and safeguards idea. Threats are the things that are very specifically and definitively spelled out in the code as the things that will cause potential non-compliance with the rules. So the AICPA's conclusion on this was that really all of the things conceptually that we face that will cause non-compliance with the rules that are in place can be bucketed into these 7 major threats groups. So that's how it's organized, that's how it's focused, and that's what we're going to spend the majority of our time talking about today. What are those threats? What do they mean? And what are some examples of what they're getting at in the guidance? No specific situation will be definitively one-for-one what we see in the code, but hopefully by the end of today we'll have talked through how you can read it and interpret what's in there relative to a circumstance or a situation you might be facing. At the end of the day, we've shared, I believe, in 4 straight years worth of ethics webinars, we've shared this particular diagram, really a visual of walking through. So when we're faced with a question or an idea of, is this right, or is this something that is crossing the line from an ethical perspective as it relates to being either a certified public accountant in public practice or a certified public accountant who's working in business and industry, I'm faced with something I have to think through. I've identified a threat. If that threat may be deemed as significant to whether I should proceed with the service or the action or what I'm going to do, I need to think through what the potential outcome of that is and identify some safeguards that might be in place. And ultimately, if I conclude that this threat, as I've identified, can be protected against, safeguarded, documented, why I believe it's okay, then I come to a conclusion and I move forward. If I choose not to move forward, I think a key word that I just threw out was documentation. If you are concerned about whether you're making the right decision, always sit down, work through the code, document your conclusions and why. And certainly we'll get to a little bit later in our webinar some resources you can consult to try and figure out whether you made the right decision or not. AICPA has folks that can help you with that and are more than willing to. So simple process, but really the meat of it is, let's talk today about what are those threats, how are those threats defined, and we'll go through some examples of those. So before we do that, just to get a better sense of who's in our audience, and today, as with almost all of our ethics webinars, we have a large volume of participants. I have my suspicions as to why that is, and I'm not sure it's because you're all dying to know about the 7 threats defined in the Code of Conduct. But to help us understand who's in our audience, the first polling question, which is necessary for CPE credit, is to answer the question, as defined by the Code of Conduct, I would classify myself in the category of A, in public practice. You're with an accounting firm, you're a sole practitioner, and you are serving in a audit or a tax capacity. B, in business, you are working for a organization, a nonprofit, a corporate entity, a consulting group that is serving as an outsourced management function. So that would be defined as in business. And C would be other. I'm between positions, I'm retired, I don't have a foot in either of those other 2 worlds. So take just a minute. And answer that question, and we'll leave it open for just a few more seconds, and then we'll find out who our audience is, and we'll go from there, because I think as you'll see over the next 20-30 minutes, we'll talk about both public practice and business. This will give us some thoughts on how we specifically focus some of our conversation.
Great. You can see here, thank you all for answering that polling question. The majority of our audience are those of you in business, with second coming in public practice. That's not a surprise. I think a few of our folks are on this webinar as well, getting their ethics CPE, or they just wanted to tune in to hear Mike and I speak today. So thank you all for answering that, and we'll continue with our slides. So here's a focus on the 7 threats. I almost wanted to call this the 7 deadly threats, but certainly something we should take seriously in our profession. So we identify these threats and their adverse interest, advocacy, familiarity, management participation, self-interest, self-review, and undue influence. And we're going to spend the next several slides walking through what the code says about each one of those and sharing some examples with you, both from the perspective of members in public practice and members in business, which the majority of you are. So the rest of this webinar is really going to focus on that step 1 of the conceptual framework, which is identify the threat. And in a lot of ways, that could be the most difficult part, just recognizing that you have one of these threats out there. So moving to threat number 1, adverse interest. So this first is focused on members in public practice, and it's really a threat that you will not act with objectivity when you're serving your clients. So a lot of this, if you read through with members in public practice, when there's going to be litigation involved, whether it's against the client or by the client or between individuals or officers or directors of the client, that litigation is really going to say, are you able to act in the best interest of your client? And this adverse interest would say that it's very likely that you're not. And so you have to identify that and be able to move through the framework to see if there could be sufficient safeguards that you can proceed. A lot of this also focuses on, is there a conflict of interest? For you personally, you'll see that we'll through a couple of these threats as we go through them. But are you certain that you can put your personal interests aside so that you can do what is best for the client?
Janice, one of the questions we get, and I will apologize in advance because I didn't tell you I was going to ask this. One of the questions we get often as a public accounting firm in an audit practice is this idea of serving as an external accounting firm for somebody who's in the same industry as a prospective client. So it may be worth, because I do think folks see that as an adverse interest. How can we serve 2 competing entities? So what in our profession maybe is the right answer? Because we have a lot of folks in business who may think that about their accounting firm. You serve one of my major competitors. What is the answer we can give them? 30-second version on this webinar to just address that, because I know we talk about it fully because we don't see it as a conflict of interest in that particular circumstance.
I absolutely wouldn't see it as a conflict of interest there. Your knowledge of the industry, your knowledge of their business is certainly a benefit. We certainly would maintain confidentiality and not share anything that we can't share with others. And we have to make sure that we're not going to have a threat here of adverse interest. And there's nothing in us opining on financial statements or understanding your business that would create a conflict for our firm. Is there anything you would add to that, Mike?
No, it was a delightful answer. No, and I know that, again, I don't think under the code that necessarily defines as an adverse interest, but I do think that that's a question we get often, and I appreciate that answer. I think the most important thing to me is the confidentiality requirements that govern our profession, and would say that even if I find out something tremendous and I like, and this would never happen, of course, but I like client B better than I like client A, I'm bound by our profession to not share trade secrets, things that I see with client A that I think would benefit client B. So certainly I don't see it as a concern or a question, but I know we get that in the marketplace occasionally.
Great. Thanks, Mike. So we're also looking at adverse interest here, still threat number 1 from the perspective of members in business. And this again comes down to objectivity, but it's your objectivity when you're dealing with your employee organization. Can you be objective in the role that you are fulfilling for them? Can you make sure you're not violating any laws or regulations? Are you sure you don't have too close of a relationship with a vendor or a customer or a competitor of that business? And again, if the member has sued or expressed an intention to sue, it comes back to that litigation and those lawsuits. Certainly when you're involved in litigation, that would create an adverse interest threat. So it really comes down to you need to be able to put your personal and your self-interests aside and be able to think of what is best for the company that you're working for, or the employing organization, as they say it here. If you look at that point number B, a member or a member's immediate family or close relative, if you have financial interests there, there's also other examples where we'll have, like if you're reporting directly to an immediate family member and things of that nature. We'll talk about that under some of the other threats, but there are certainly things as a CPA in the profession. Obviously it happens. There are a lot of family-owned businesses, but things you need to be thinking about to make sure you don't have an adverse interest.
So adverse interest is really focused on that idea that you will lack objectivity because your interests are opposed to the interest of either the client or your employer. Advocacy is a little different. Advocacy is the idea that you will lack objectivity because you are so in favor of doing the right thing for your client, in this case, and we'll talk about members in business in just a moment. But in public practice, it's this idea that you want to put your client first, and you want to put your client's needs and what will benefit your client ahead of making what might be the right ethical decision. And just to clarify, as you see this set of slides, you'll notice a common theme. First slide in each section, each threat will be members in public practice. Second slide will be members in business. And the examples that we've listed here are examples that come directly out of the Code of Professional Conduct. So these are not Janice and I sitting down and saying, let's come up with what's a good example of an advocacy threat for a member in public practice. These are items that are directly out of the code. And I think our goal today is both to point those out, but also point out maybe some real world examples that we see as potential things that have to be navigated through and thought through. So under the advocacy threat, as I said, it's the idea that a CPA will promote a client's interests or position to the point that you compromise your independence and objectivity. So you can see a few things listed on there. Examples that I think come up more often than we really talk about because they're just such a common part of what we do. We have a client that perhaps is looking to sell the business. And in selling a business, the desire is, of course, to maximize value. And there are ways to maximize value through making some changes in accounting estimates. There are ways to make cash flows look a little bit different. There are ways to change projections and tweak things in a way that I think a member in public practice could very easily rationalize with themselves and say, yes, this is a very plausible projection I'm putting together, and I think it makes a lot of sense. And if we tweak this percentage a little bit, it maybe gets a little better valuation for my client, maybe gets a little better answer for them. And so the ethical dilemma, which I think we face every day in our profession, is we need to do what is right. And I think we largely as a profession, we do conclude on what is right. But with any right answer in accounting, in business valuation, et cetera, there's a gray area. And the question is, do we wrestle enough? And I think as a profession we do. But that's what this is getting at, is do we wrestle with where does the gray become dark gray? And where does the dark gray become we're stepping our toe into trying to maximize something for our client when we know deep down it's probably a stretch that answer would be supportable? So that's what this is getting at. Another example, as a firm, we work with a lot of large, complex entities. We also work with a lot of small, very straightforward entities where the accounting is pretty straightforward, and the users of the financials might be a bank and the shareholders. The users of the financials might just be the shareholders and management team. And sometimes this whole idea of advocacy can be as simple as, look, we had a really bad year this year. I want to take all the bad this year and I want to save a little bit of the good for next year and start off on the right foot. And as an accounting firm, as a member in public practice, you have that decision of, does it really hurt anybody? Well, probably not. So I want to do what's right for my client, but reality is right and wrong is wrong. And so our guidance here would point us to the conclusion of, I can't lets you do that, even though it doesn't hurt anybody, even though it's in your best interest to maybe save a little bit of good news for next year. The right answer, which we would all agree, is that right is right, wrong is wrong, and let's get the answer correct, even though I want to be your advocate and help you get better positioning for things in the future. And at the end of the day, does it really hurt anybody? Well, probably not, but that doesn't change the answer. Members in business, very similar concept, but instead of the threat that you will compromise your objectivity in favor of what's best for a client, it's compromising your objectivity in favor of what's best for your organization. The simplest example of this that I can think of, and it's really addressed in point A, is a bank renegotiation. We know that our 5-year term is coming due. We know that the bank and the underwriters are going to look closely at this year's financials and my applications and my projections and my business plan. So if I know I have some razor thin margins on things, do I have incentive to paint a better picture or to classify things a little bit differently in a way that that maybe isn't out and out wrong and out in my mind unethical, but it's gray and I'm trying to get a better answer. That's the advocacy threat. It's not obvious, but I'm doing something strictly because I think it's in the best interest of the organization, even though I'm not 100% sure it's really the right thing to do. So that's an obvious example, but those are the things we need to think about on the advocacy threat as we work through really the decision making. Am I doing something that in my gut I know isn't quite right because it gives me a better answer, and that's better for my company, and because it's better for my company, it's better for all the employees, and I'm a wonderful person and I'm doing what's right even though I know it's not right. So that's what we're trying to get at here.
I think in public practice, we talk a lot, we have objectivity with this advocacy threat, making sure we're not going to, but we have independence rules as well. When you're a member in business, you don't have those independence rules that are really governing you on top of the advocacy threat or making sure you're maintaining your objectivity. So I think sometimes that you're there for a long time, that can get a little blurred. This moves right into threat number 3, which is familiarity. So this is, are you really too familiar with either your client or with your employing organization to be able to follow the code that's required for you as a CPA? Are you too sympathetic or too accepting of what's put in front of you? And the first one here, a member's immediate family or close relative is employed by the client. So we can certainly see that here. And, you know, I've had to wrestle with situations like that where a very close family member, a spouse, a child, something like that has an incredible resume and would probably be someone wonderful to work with. But we really just can't go there because they could potentially be working with that close family member. They wouldn't be objective. They'd be too familiar. And these are things to think about in the public practice side. As well as I've heard one, if you say you have too close of a business relationship or a long association with a client, I hear different things like, oh, we've gone out to dinner, we've been in the firm suite, and that's all okay. But then when someone says, oh, we spent 4 days and went to the Super Bowl together and they bought us tickets and you're actually now like vacationing and you're going way above and beyond, you may have to step back and say, am I a little too familiar with this client and with this contact? And I think we all have to be aware of that.
And I think it's a great point. And in professional practice and public practice, goal number 1 is in client service is to have a great relationship with your clients so that you can have those hard conversations. But there is a line between a great relationship between someone in a public accounting firm and their client and becoming too close to where it would impair the objectivity.
Yes. Thanks, Mike.
So don't go on vacation.
I think I'm good on that one. So the familiarity threat from the perspective of members in business. So you think immediate family members, if they're close suppliers or two organizations are very closely linked, could something inappropriate be going on because you're too sympathetic to their interests? Are you accepting work product from someone because you've worked with them for the last 30 years and you're so familiar with your work and it's so great and they never make a mistake that you're really not questioning and challenging what they're presenting to you? I think you need to keep that in mind as you're in business. And certainly you wouldn't want immediate family members reporting to each other. inside the organization. So you want them in direct reporting lines, particularly in an accounting function, the CPAs that need to maintain their compliance with the code. You need to keep that in mind and see, is that really a threat? And the last one is regularly accepting gifts or entertainment from a vendor or a customer. There's a lot of great fraud schemes out there that certainly have crossed the line to being inappropriate, where employees are actually making money off of these relationships, or they're getting significant kickbacks and things that just wouldn't be appropriate. And this comes back to gifts as well. Taking you out to dinner, or tickets to a hockey game or something may not be a big deal. You cross the line and it's the Super Bowl and it's thousands of dollars or whatever that may be, but regularly accepting those gifts or those very large items or entertainment, that can start to raise some red flags that you would need to evaluate this familiarity threat.
Yeah, and I think it's easy to draw a line in the sand and say, we're not doing any of these things. And we respect the organizations that have that position. It says, I cannot accept any gift or entertainment. I cannot come to a sporting event with you. I cannot go to a play at the Hershey Theater with you. We respect that because it makes it easy to make the decisions. Reality is most organizations, a lot of organizations allow it. And the question is, do we recognize in ourselves when we are crossing a line of, I'm losing a little bit of my objectivity because I want to make sure that Janice takes me to the Super Bowl next year. And so, or I want to get invited to XYZ's golf outing because it's the best golf outing in the area. And so I'm going to maybe be a little more lenient in terms of how I hold my vendor accountable or things, because I just want to make sure that I keep that relationship coming. So the important part is the awareness. And as Janice said, it's a familiarity. I think it's okay, but it's an awareness of when it's starting to compromise our objectivity and start to change our thought process, because maybe it's just a little bit too much of the gifts and entertainment, and I'm focusing more on that than I am on, am I getting the right service, the right level of responsiveness from the vendor.
All right, thanks.
So moving on, threat number 4, and we're going to break from our tradition here that we've set over 3 threats of members in public practice followed by members in business. And our 60-odd% of our folks who are in business who are on the webinar, you can listen to this one, but I'm sorry, there's no next slide for you. Threat number 4 is really specific to members in public practice, and it really is the crux of what a lot of public accounting rules around independence and non-attest services are based on. So threat number 4 is defined as management participation. Again, only for public practice. There is no concurrent threat noted for members in business. But it's the idea that we will do things as a public accounting firm or as a sole practitioner, we will do things that will actually put us into a role of client management. And by moving into the role of client management, we then, by definition, can cross some lines into whether we can perform services that require independence. So there is probably a 30-minute webinar baked in just to management participation that would be very specific to some of the allowable non-attest services, some of the risks that go along with those, some of the safeguards that can be put in place to allow them. I'm going to keep it fairly short and fairly succinct for today. First and foremost, I would say there are a lot of things that a CPA in public practice can do for an attest client that would not compromise their independence. There are even some things that a CPA in public practice can do for a client that on the surface you would think might compromise my independence. For instance, can we do reconciliations and propose journal entries to true up accounts? My gut on the surface would be, well, that's probably because then I have to go audit those accounts. Part of the audit is looking at those reconciliations. Of course I can't do that. But provided the right safeguards are put in place, and we'll get to that a little bit later, that's a service that a CPA in public practice can perform for their attest client. There's a lot of things like that, that really the point is identifying what those things are and ensuring that the safeguards that we'll talk about later are put in place to ensure that we are not assuming management responsibilities because the assumption of those management responsibilities will, by definition, impair our independence. And independence in public practice is, again, it's a whole nother webinar. It's another 20, 30-minute discussion just on a few key areas. So we won't get into that. What defines being someone who assumes management responsibilities? Things like, are you the ultimate decision maker? Are you committing the organization to a path or a course of action? Do you have custody of their assets? So a CPA cannot have custody and signing authority on their clients' bank accounts or investment accounts, things like that. We can't commit the organization. We can propose things to a client, as long as that client takes the ultimate responsibility for making the decision and is capable of making those decisions and has the right tools, information, and understanding. So something to be very careful of, something that in public practice is very important and critical to us as a firm. Most of what we look at when it comes to independence are not these other threats. It's looking at what kind of work are we doing for an attest client, and are we doing the right things to make sure we haven't bridged this management participation idea. Only other point I want to make on this particular threat, if you look at the AICPA rules, as I said, there's a lot of things that a member in public practice can do for an attest client that does not cross the line. If you look at the governmental regulations on independence and objectivity, and if you look at the PCAOB's rules, you will find a very, very short list. And in the PCAOB's case, there's pretty much no list of things that are permissible. So you do need to understand the environment you're working in. When we talk about management participation in this context, there are a lot of things under the AICPA Code of Professional Conduct that can be done if the right safeguards are in place. However, in a public organization, a broker-dealer, somebody that falls under the PCAOB's purview, those things go away very quickly, and this idea of management participation becomes it's a go, no go. There's no gray. There's no safeguards that you can put in place, and similar in the governmental world. So we are going to move to, I'm not sure whether this polling question or the final polling question will be the most telling, but our next polling question is as such. I'm taking this course primarily to A, refresh my understanding of professional ethics, B, get tips on dealing with an ethical dilemma I'm facing, or I might reword that to figure out where to go and what to look for to interpret the rules, or C, it's a reporting year, I really need the CPE, and that's why Janice and I are here for you today. So we'll leave it open for a few more minutes. I suppose, based on Janice's earlier comments, that I should have put in a fourth option. Just wanted to hear Janice and I talk about any topic, whether it's ethics or the nonprofit reporting standard, which would be all Janice, no Mike. But with that, I think we've got, leave it for about 10 more seconds.
Yeah, I'll be curious to see this one. I think a lot of people really need the CPE. These odd reporting years are very compelling, but we'll find out the answer shortly.
I got to be honest with you. I am excited by the number of you that selected A, and then maybe 2 or 3 of you that selected B. If you need some one-on-one conversation and counseling on working through the ethical dilemma, you feel free to call us. We'll work you through the details we will probably not be going through today. And C, there's no real shock or surprise there. We do understand that when we do an ethics presentation in a odd-numbered year in Pennsylvania, we get a lot more interest than when we do an ethics presentation in an even-numbered year and somebody's not chasing those credits.
Absolutely. Thanks, Mike. So with that, we'll take it back to our threats, and we'll focus on threat number 5, self-interest. So a lot of this comes down to, are you going to benefit personally from this? And this first is focused on members in public practice. Can I benefit financially in some way? There's a lot of good examples here where they talk about financial interests. You know, You shouldn't own significant amounts of stock or ownership in a company. That's definitely prohibited. But does your spouse do that? Does a close family member have that financial interest? You need to think of those things. Are you working on a contingent fee arrangement? In some cases that's permitted. In a lot, it's definitely not. And you hear a contingent fee arrangement for a tax refund is a very specific example that is something that would violate the self-interest threat here. Excessive reliance exists on revenue from a single client. So is one client so large to the firm, there have been firms that this has affected in the past, that that very large client can influence the decisions that you're going to make, because that's your business and that's your future and that's how you support your family. So are you really capable of not thinking of your own self-interests when you're serving that client? Some of the other ones that come into mind or that come into play here for self-interest is, I shouldn't have loans back and forth with clients. On the surface, that sounds really simple. I mean, I work with a lot of healthcare organizations and food manufacturers. I'm certainly not going to be borrowing money from them, but that can get a little different when it's a financial institution. How large is that loan? Could you be impaired because you want that institution to do well because you owe them money? Things of that nature. One we talk about in public accounting is unpaid fees. There are very specific independence rules when you hit certain limits and certain time frames, that if there are back fees, you're kind of violating those independence rules. But a self-interest rule, you have to think about that sometimes a little more in the short term. If a client's not able to pay you or something's going on in their business or things of that nature. So certainly things that we have to think about and deal with as members in public practice. As we move on to the members in business perspective of the self-interest threat, yes, you can still have those. You can still be invested in your organization. You can still benefit financially. The last example down there is the profit or the performance-related bonus. So certainly if you're the CFO, you're a licensed CPA, you're bound by the ethical codes here and the code of conduct. Are you working in your own self-interest? Because there's a sizable bonus on the line if the company's financial results are better. Are you playing with those reserves? Are you looking a little harder at those allowances because you're really close to a threshold? And that's certainly where you got to pause and say, I don't know anyone who wouldn't like a bonus, but is it actually affecting the way you're reporting those numbers? And is it influencing your decisions in a way that you're really not able to be objective and you're not able to make decisions without thinking of your own self-interest?
In a lot of situations, and I think we'll get to some others a little bit later, but a lot of situations don't fit cleanly into one bucket. The self-interest threat really talks about financial interest and financial benefit, but you extend that to even the simple idea of if I don't report, if I'm in a public company and I don't report results that will keep things where they should be, do I lose my job? Does the company collapse because the investors pull back? And ultimately, is it still financial interest? Absolutely. But it's really more self-preservation. If I had reported the truth, I'd have lost my job, and I'm the primary support mechanism for my family. So what do? Well, I might tweak things a little bit here and there to make sure, just to make sure I have the security of having a job for the next year while I try and find a new one.
And that's not just public companies. I mean, that can be private companies as well. If you have some difficult times, or the bank's watching you very closely, or you might have some failed debt covenant requirements and you're wondering what the bank is going to do. That certainly could be in your best interest or your own self-interest to make the company look a little bit better than it actually is. So you just need to step back and say, am I able to think about this and act in a way that my self-interests aren't superseding what's the right thing to do?
And I think we'd all like to sit back and very simply say we would obviously do the right thing regardless, because we know what the right thing is. But until we're in that situation, it's really hard to know when your back's against the wall what exactly you would do. So the self-review threat, fairly straightforward, and there's not a whole lot of exciting examples or things that I think we can think of and give on this. Members in public practice, the self-review threat is defined as the threat that you will essentially you'll accept the results of a previous conclusion you made or something that's given to you. You'll rely on something that essentially either you or somebody else in your firm previously did. So, example, in terms of let's say an audit, a technical decision that was made 2-3 years ago by the firm as part of the professional services. Do you really unpack it, or do you just trust that the decision you made or the decision that the firm made 2-3 years earlier was obviously the right one because it was our work, and so I'm not going to dig back into it? I think this would imply clearly that in any given year, as we should be doing, we should be revisiting those things that we did in the past and make sure we come to the same conclusion this year. Another example, we might rely on something that was done by a different segment or practice area of our firm. Simple example of that would be a business valuation. In a lot of cases, as a public accounting firm, you can do the business valuation for a test client as long as the results of that business valuation are not used by you in the audit. So if that business valuation is for family gifting purposes and it really doesn't impact the financials, no worries. But we get into the self-review area when that business valuation that was done by your business valuation practice now drives the deferred compensation liability that you're opining on. So can we do that? I think the only way you can do that is to appropriately address the self-review threat. Maybe there's ways to do it. Maybe you have to engage a third-party independent valuation firm to reperform the valuation, something like that. Point is, that's a self-review. That is relying on something that was done by your firm or by you previously, which clearly I think anybody would conclude does not allow you to be objective and independent in what you're trying to do. Bookkeeping is another very clear example. Doing all of the bookkeeping for an entity and then coming in from a test perspective, and then trying to rely on the bookkeeping that you did and all the checks that were written, the journal entries that were booked, all the things that were done. I'm not sure how it's possible to be objective when you are testing and reviewing the work that you or someone in your firm did. So pretty straightforward on the self-review threat. It's just the idea that you can be an objective, independent individual when you're looking at someone else's work, but not when you're looking at your own. For members in business, very similar. The examples that are given, I think, are pretty straightforward. I couldn't come up with anything more interesting. But at the end of the day, let's say an individual who was in a billing department changes career paths, moves into an internal audit position, and that internal audit position is charged with now testing the processes and results of what was done in the billing area. And the idea that I'm now going back to look at what I did, well, obviously I did it right. I don't need to dig in. I don't need to really explore it because I know it was right. I'm good. I did it. What obviously would be a concern in terms of professional judgment and whether we're doing the job we're supposed to do. So self-review, exactly what it sounds like, not really a whole lot more to unpack there.
All right, moving on to the last of the threats. Threat number 7, undue influence. This really comes down to, are you in a position as a CPA, as the member, that someone is being very aggressive or domineering or coercing you to do things that you don't believe are appropriate? And in public practice, I think we could be threatened. You know, I'm going to fire you. I'm not going to continue your services. You're going to do what you say. You're going to do what I say. You can also see in public practice sometimes if the client is trying to influence the audit. So they could be saying, I'm going to tell you what you can do and how you can test it. Many, many years ago, before I came here, I had a client once that said, we're not allowing you to test executive payroll. They were being very dominating in that. And we finally had to say, well, someone, even if it's the engagement partner, has to be able to test that. You can't limit the scope of our audit. But they were certainly trying to be aggressive or dominant in coercing us to do what they wanted us to do. You know, sometimes it's on a lesser level, but we still got to make sure that we're doing our job as a member in public practice. You know, are you sure you really need to look at that location? Or I'm not really sure that this entity is material. So we have to think about that and make sure we're not allowing our judgment to be coerced or influenced by those decisions. in terms of a member in business and undue influence, it's still a very similar thing. You can have aggressive or dominant personalities. So is there someone above you that's coming to you and saying, you're going to take this information and you're going to present it in this way, and you're going to do it just like this because this is the outcome that I want, and you're going to convince the CEO or the board or the owner of this position, even if that's not necessarily what the financial information or the data would lead them to want to do? Are they really trying to influence your expertise and your knowledge? Do they want you to deviate from a company policy or something that is written? Are they really putting that pressure on you to make a different decision in your accounting conclusions or things of that nature? Or are they trying to influence who you hire for your department or your team? So, we're going through a lot of our recruiting and hiring process now, and I certainly trust our team members and the decisions that they want to make. But speaking of members in business, if you have a department or you have a team and you're being told who you have to hire regardless of qualifications, there's certainly putting some excessive influence over you.
So that's the 7. And I think one thing worth pointing out, fairly obvious, but that's what I do, is the way some of these tie together. So an example that I used earlier regarding banking relationships, right? It's time to renegotiate banking relationship. And you're sitting down as an individual looking at, how do I determine whether I present the spot on truth or bend it a little bit because I know it's a little more favorable in a tough environment to get financing. And you sit back and you think, well, I have a boss who is going to yell at me to make sure I do this correctly. So I have undue influence who's pressuring me. I have self-preservation to make sure that I keep my job and get paid. And if we don't get the financing, the company might go under. So I have a little self-interest going on. And of course, the right thing to do to protect the company is to get the financing and be an advocate. So I have the advocacy threat. So in one circumstance, I might be dealing with 3 very different threats to get me to bend from what I know is probably the right answer from a financial reporting perspective, but I'm going to lean a little bit because there's just numerous factors pushing me into a space that says, yeah, I've got to do this. I've got to bend it.
And certainly most of the examples as you go through the code have multiple threats within them. I think it would actually be pretty rare to have examples where you only have one threat. It certainly can happen, but more likely than not, you're going to have multiple that are going to overlap, and you're going to have to consider each one of them.
So our third and final polling question as we come into the home stretch here, taking ethics training every 2 years to fulfill my CPE requirements clearly makes me a more ethical person. True or false? So we'll leave this one open fairly briefly because it shouldn't take you a whole lot of time to come to your decision on whether that's a truth or a false. But while we're waiting on that to be finalized, as we get into our final section of our discussion today on the safeguards, just a reminder to please submit any questions that might have come up. And if we have time at the tail end, we will address those live on the webinar. If we don't have time at the tail end, your name will be associated with that when you pose it. You can raise your hand, and we can circle back with you if it's a specific question that can be answered. So please take a few minutes. If you have a question here, we've got about 10 minutes or so of information left to deliver, so you have some time to put those questions in.
So a little over a third of you do think it's true that this helps make you a more ethical person, and about 2/3 of you think probably not. I mean, I think it's a good refresher. It's good to talk about these things from time to time. It's not a bad thing.
No, I tend to be cynical on it, and I think that being forced to take training to make people more ethical is a bad answer. I do believe the ethics training as required adds a lot of value because it helps you understand what the profession views as risk, what the profession views as important to making decisions, and really might get you thinking about some things, situations you're currently in where you're making the right decision because you're an ethical person, but it gives you a framework and words to put around why what you're doing is appropriate within the profession. So I tend to be cynical and think you're either an ethical person or you're an unethical person, and training doesn't help with that. But I do think there's a lot of value in the mandated training to make sure that that we have the tools and the framework around the decisions we're making.
Okay, great. Thanks, Mike. So as we said, step one was in the conceptual framework was to identify the threats. Step two is to evaluate those threats. So we gave you the 7 threats. We walked through some examples, not truly evaluating, but giving you some examples and things to think about. And step 3 is to identify those safeguards. And we have those safeguards here on the screen. So these are things that can help eliminate or reduce a threat so that it could be at an acceptable level. So you may have a threat present, but you feel okay that you can still proceed. So the safeguards really fall into the 3 categories listed here: safeguards by the profession, legislation, or regulation. And Mike's going to touch base on some of those, and then I'm going to walk you through the last 2. So go ahead, Mike.
Great. So safeguards created by the profession, tremendous list of things that the AICPA and public accounting in general and the GAO require relative to ethics training and independence training and understanding what's required there. There's very specific rules, as Janice said earlier, on independence, what you can and can't do. So those safeguards really are the rules that allow you to decide what you can and can't do when it's a black and white situation. Other things that are required, of course, training. We talked about training in our polling question. I think I've given my answer on that. I think it's worthwhile in the education side. It is a safeguard in my mind because it allows you to understand what the thought process needs to be when you're deciding things. The one thing I wanted to point out is we're running down on time. I won't spend a lot of time on this slide, but I wanted to point out, I said earlier, there are resources available to you if there is a particular question or concern that you may have in place. And I'm going to give those to you right now. They're not on the slide, but there's an email address and a phone number. Email address, real simple, ethics@aicpa.org. They will answer your question. I don't know that I've ever known anybody who's actually reached out to it, but they do publish some statistics on the most common things that are asked of them. So ethics@aicpa.org is a great resource if you're really wrestling with how do I decide. So it's a resource. Safeguard in context of it allows you to validate the decisions you're making or the conclusions you're coming to. The other is a phone number. If you're not an email type of person, the phone number is 888-777-7077. I'm more inclined to remember ethics@aicpa.org, but that phone number will get you to the same folks at the AICPA who will help you navigate through, from a professional perspective, what your obligations are in a particular circumstance.
Great, thanks, Mike. So the second type of safeguard to look at is for those of us in public practice, which we know is only about 1/3 of those on the webinar. But we talk a lot about when we're really assisting a client or maybe proposing some journal entries as part of the audit, or we're preparing financial statements for management's review and approval. We look at a lot of, does the client and the personnel have suitable skill, knowledge, and experience to take responsibility for the information that we are putting in front of them? And so this is a pretty big deal to eliminate some of these threats as we look at them in our profession. So we look at the suitable skill, knowledge, and experience. We also look at the tone at the top of the client. Do they have a commitment to fair financial reporting and compliance? So what does their governance look like? What's in their handbook? But what really permeates through the minutes of their meetings, through their discussions, through the trainings that they have? And then the governance structure that's in place. Do they have an audit committee or an oversight committee? Is it the board? Are the owners heavily involved? How does that really help us to make sure that any of these threats have adequate safeguards that would be put in place? The next one, continuing with, these are for members in business. So these are the safeguards that can be implemented by the employing organization. It really would be a great thing when you go work somewhere if you ask a lot of these questions as you're being hired, so you kind of know what you're walking into as a CPA. Hopefully most of you do, that you've interviewed long enough and you've vetted the organization. But do you really understand the tone at the top of the organization? Do you understand their policies and procedures and how they're going to address ethical conflicts? And when different things come up, how do they funnel that? Is it through human resources? Is it through an audit committee? Depending on the size of the organization, what would make the most sense? And what are those internal policies and procedures that you would go through at that organization? And how do you know there's not inappropriate vendor and supplier relationships and things like that?
Right, so those 4 items that Janice just touched on are 4 of 18 that are specifically listed in the Code of Professional Conduct for an employing organization. I think we selected those as probably the 4 that were the highest level, most applicable broadly, but there are 18 individual safeguards listed as being recommended for an employing organization. So for those 60-odd% of our attendees who are in business, if you go to the code, and it's available on the AICPA's website, if you go to the code, you will see a list of 18 things, including these 4, that are things that maybe you should be thinking about whether they're applicable for your organization to enhance the ethical environment in which you're playing.
Great. Thanks, Mike. And the last one are safeguards implemented by the firm. So this obviously relates to those more in public practice. So does the firm you're working for have these things in place, including leadership that stresses ethical behaviors, training, ethics training, things of that nature? Are they following independence rules and those other items listed there? Since it's only about a third of our webinar guests, we're touching on those pretty quickly. But also good client acceptance and continuation policies are pretty important, so you know who the firm is working with and it's the type of organizations that they want to be working with.
Yeah, this area in the code gets very granular. We listed A through F. We could have gone through Z if we wanted to use a number of slides. But I think from an AICPA perspective, well, there are a lot of things they're very concerned with for members in business and making sure that the ethical environment within the business is appropriate and that the company has some adequate controls in place to make sure things are done right. AICPA is really focused on making sure accounting firms don't cross the line, and I think there's a much broader range of ways that individuals in public accounting can find to violate the code of ethics. So that's why we have A through Z, to make sure we get there. So our final conversation can be summed up very simply. Safeguards are internal controls. They're internal controls that are put in place by the profession, by legislation, by clients, by entities. But as with any internal control, it's only as good as the individuals who are implementing it. It's only as good as the way it's designed. It is only as good as the consistency with which it's applied. So this slide is simply summed up by saying, just because you have all good safeguards in place does not assure or confirm an ethical environment will be in place at the firm or at the employing organization. It takes a lot of work, diligence, focus, things like whistleblower hotlines, things we've talked about in other webinars to make sure that the right environment is in place. So you can read the things that are on screen in terms of the things the AICPA defined as risks to non-functioning safeguards, but I think it's simple to sum it up. It's only as good as the effort that's put into it.
Great, thanks, Mike. I think that concludes our webinar for today.
Yep. And with that, we have a grand total of no questions that were asked. So clearly, Janice and I were as clear as could be and answered all of the burning questions that you had. So any follow-up questions, though, we do invite you to ask if there's any direct questions you might want to explore, conversations you might want to have, whether it be on the topic of professional ethics and the code and how to interpret it, or anything that as a firm we can do to shed light on any of the things we've talked about today or be of assistance to you. Our contact information is there. And we invite you to reach out to either of us, and we'd be happy to talk about those. So thank you for your time. Thank you for your attention, and we will turn it back over to Melissa.
Thank you once again for joining us for this webinar recap produced by McKonly Asbury. We hope you join us for our future webinars. You can stay connected to us and learn more about all of our upcoming events by visiting us at macpas.com. Thanks again, and have a great day.